Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Welcome to the Investing the Templeton Way podcast. I'm your host, Lauren Templeton.
And I'm your co-host, Scott Phillips.
And I'm excited about today's guest, Christopher Begg. So Christopher is the Chief Executive Officer, Chief Investment Officer, and co-founder of East Coast Asset Management. He is also currently serving as an adjunct associate professor at the Heilbronn Center of Graham and Dodd Investing at Columbia Business School, where he teaches security analysis. And if my listeners don't know, this is a very famous course at Columbia University that was originally taught by Ben Graham. And then in 1951, I believe, Warren Buffett was one of the students in the class. So it's very prestigious to have this position teaching the course, and you teach it in the fall. And I originally met Chris at a Templeton investment roundtable in London pre-COVID. So I'm thinking this was probably 2017, 2018, something like that. And was fascinated. He manages money from one of the Templeton foundations. I was fascinated by his investment philosophy. He manages a very concentrated portfolio. So we'll get into all of these details today, but we want to welcome you, Chris.
Thank you, Lauren. It's great to be here. Thank you, Scott.
Yeah. So tell us a little bit about your history, how you got started in investing, how you ended up as an adjunct professor at Columbia University teaching this important course. Where'd you get started?
Yeah. So my journey started over 20 years ago, and I was fortunate to have a father who was also worked in the service industry. He was an accountant, and I kind of looked at what he was doing and accounting and kind of being held accountable to others. And so I told him when I was young, I was like, I want to be an accountant too. And he said, no, you don't. And basically kind of steered me in a direction to do something else, but similar. I definitely had an interest in numbers and loved reading and things like that. So I ended up finding my way to investing right out of undergrad. I was lucky enough to get a position as a research analyst, and basically did anything I could to spend more time kind of reading annual reports. And I was lucky enough early on to stumble on the teachings of Warren Buffett and Charlie Munger through a lot of the Berkshire Hathaway annual reports and so forth. So, that was, once I read that, everything changed for me. I kind of understood that I wanted the type of investor that really matched my temperament. Mm-hmm. And I spent about 10 years at my first job at a firm called Boston Research and Management. And shortly after that, I was ready to kind of go off on my own and launch something that I thought really could be my own canvas. Buffett talks about painting your own canvas, and that was important to me at some point. And my co-founder was willing to do a lot of the operations, and I was able to, focus primarily just on research, just on thinking about how to build really a long-term oriented portfolio that was, thinking about how do we compound returns at superior rates over the longest duration. So what we're doing now is, a really sub 10 business portfolio thinking about, really long-term returns that we're really proud of. You had asked about the class, the initial connection to Columbia Business School and security analysis was really, having interns that were part of the value investing program there, which I thought was best in the world, still do think it's best in the world, have them intern at our firm. And one thing led to another, and I was able to meet Bruce Greenwald, who I respected, quite a lot. Competition Demystified, still one of my favorite books. Bruce and I worked on a handful of students together where I was, they were able to, work at East Coast and get credit. And Bruce was the professor on that. So he had asked me if I'd be willing to teach a course. And I said, well, what would you want me to teach? He said, oh, just teach what you do. And I said, oh, I can do that. And, so I framed really a curriculum that I thought made sense, that was still open enough to consider all the different types of value investing there is. And I've had a lot of fun with it. The course has evolved, and, I think about it as a research laboratory. It's a way to come in the way Ben Graham, I think, did in those early years and talk about what's relevant in the world, talk about what's relevant in, what operators we should learn from, what investors I think can shine a light on truths about business and operating and investing principles. And I think some of the things I've seen now come back is seeing these students kind of go off and be, incredible investors, and there's a reciprocation there that's really been a real benefit to the whole experience.
Yeah, I was about to ask, who do you think gets more from the course, your students or you? Because I can imagine that doing this every fall, designing the course, listening to the speakers, connecting with the students, talking about things that are relevant today, that really keeps you very fresh and keeps your mind working on investment problems or opportunities.
And I will say, one of my esteemed speakers was Lauren and Scott. So we had fun. I think it was you guys are due to come in. I think it's been 3 or 4 years. So
well, don't put us on your list, because we don't deserve to be there. That you have had just some of the most amazing speakers. Do you want to review for the audience quickly who some of your esteemed speakers are? Maybe who some of your favorite ones have been over the years?
Yeah. So what I tried to pull from in kind of giving kind of a full perspective. So a lot of people might not know, but Ben Graham used to open his course with a Spinoza quote, "Sub specie aeternitatis," which means to see things under the aspect of eternity. And so when I think about what would a full security analysis course would be, is to think, how would they get exposed to operators? So some of the great operators we have the Mendelssohns from Heiko that come under here. 30-year record of 20% compounded returns. Just so incredible the way they've run that business. And when they come in, they bring their wives, they bring the kids, and it's such an incredible feeling of connection that they have to the school. Larry went there, and Victor and Eric have gone there. So that's fun. We have Frank Slootman from Snowflake, just a great operator. He's come in now perennially the last 3 years. I've had Glenn Fogel from Priceline and now Booking. On the investor side, Todd Combs, who sat in one of those seats that the students did, he's come in now every year for the last 10 years. And he's been just a great guest to see his, evolution, first as an investor and now as an operator, running Geico, and working side by side with Warren and Charlie is just, an incredible wealth of knowledge. We have Howard Marks usually as one of our bookend
he's great.
Speakers every year. And usually what I've tried to do throughout, just to finish off, our thinkers and philosophers, last year, one of my favorite books that's come up the last few years is The Matter with Things. And Ian McGilchrist talking about left and right hemisphere thinking and brain science. And if you have this book, it's literally a tome. It's 2 big books. But it's fantastic. And, so Ian came in and we shared left versus right brain thinking, which I think the students tend to be oriented that way, right? I think all of us are oriented toward one way or the other. So, the lesson there is, do we have a side that we can nurture? If it's not our natural strength to be creative in right brain, and we're more analytical in left brain, which I think a lot of analysts that come into our industry are, can we nurture qualities and habits that can, amplify that? Or do we surround ourselves with others that can help amplify that? And so those are kind of fun things that are usually topical to me, and it's kind of enjoyable to share that experience with the students.
Yeah, it's fascinating. I would think that the average student in finance would be left brain oriented. So how do you nurture that right side of your brain to be more creative and see the bigger picture?
That's right. And Lauren, I think it's not just the creativity that our right brain develops, but it's also context. So we've seen this with right hemisphere strokes, is that the patients actually lose context, and they may retain language, which is left brain, but they don't understand how to put things together. And I think in investing, like stepping back and seeing the whole picture is so valuable.
Yeah.
And the fact that that's the part that isn't as attractive to investing, gives these right brain thinkers, I think, a little bit of an edge, if they can harness it. So how do we harness like a more right brain orientation? I think, creative hobbies, whether it's the arts or whether it's having a real methodology for multidisciplinary learning, learning across disciplines, forcing yourself to say, I'm going to spend on this subject in physics or this subject in biology, and not being so deeply focused on one thing, but having a breadth of knowledge is somewhere where I think you can develop some of these right brain habits.
Well, I want to talk to you about that, because I've heard you mention before how, and I may not be saying this the way you want me to, but that you have a habit of identifying a subject that you want to learn about, and you give yourself 3 months, and you go as deep as you can on that subject in 3 months, and then you move on to another subject. Can you talk about that habit and how that is helpful to your investment philosophy?
I think about it in 4 dimensions, really. I think the first dimension is either we're oriented to more of a depth of understanding of one subject, or that we know a little bit about a lot of things. So I was more, I wanted to know a little bit of a lot of things early in my learning. I would take a recommendation to read this book or that book, but I was aware that I wasn't getting a depth of understanding. So this habit of taking 3 months to go deeper and really reading every single thing that was oriented around that subject. So something as crazy as humpback whales. So that was like a subject maybe 3 months ago, not 3 months ago, but last year, and just talking to experts on it, visiting different museums and really understanding that, that mammal species, how it evolved, and skeleton structures and how it communicates with others, echolocation. And so by doing that, you've just developed a real nuanced understanding of something as simple as humpback whales. And so, I've done that now, and I've done it for 10 years, and it's really helped me recognize patterns across different fields and across different, and I think in terms of kind of 4 buckets, either physics, biology, human history, and and you can kind of segment chemistry in there, kind of in between physics and biology. And so when I orient these kind of 3-month tasks, I'll kind of say, okay, this is an area that I'm gonna delve into. It interests me. I'm curious about it. So that that dimensional, you go from 1D to kind of a 2-dimensional breadth and depth. The 3rd dimension is what I kind of refer to as height, and that's seeing that timeline of the whole, kind of where this subject orients in the whole timeline. And then the 4th is this idea of networks and how, networks can kind of increase a flow of information. And that could be through our own networks or through just the way that networks scale. And so that's been the process, and it's been useful to me. I've shared it with others. And
how do you choose the subject?
It usually chooses me. There's things will just keep bumping into me. It's funny. I'll tell this little story of, there's a bookstore in a little town that I spend a lot of time in the winter. And I'll walk into that bookstore, and it's tiny, but it's so well curated. And each book, I'll kind of walk in and like, if the book wiggles at me, like, I'll want to read it. It literally is like there's usually something that will just speak to me. That's how these subjects are. They just kind of speak to me over time, and I'll just want to dive in.
Chris, one of the things that jumps out to me after listening to part of this discussion, and I think you had spoken about it before, is when you venture into these other disciplines and you really peer into them and explore them and think about them, you start to peel back these kind of universal laws or universal truths of what works across disciplines. And it often, maybe we're warped because we spend so much time thinking about investing, but it often applies to investing, like just the ideas of compound interest and things of that nature. If you run across that where you're learning and multi-disciplines tie back and strengthen your investing acumen?
That's exactly right, Scott. I think the light that went off for me was twofold. It was reading a lot about what Charlie Munger would talk about. And Charlie talked a lot about these threads of knowledge that kind of flow through. and Peter Kaufman, Peter has a phenomenal skill at identifying these general principles and how they apply across disciplines. And Peter obviously was the editor of Poor Charlie's Almanac. So, these two individuals together are just superpowers at this. But you mentioned compound interest, Scott. Like, a lot of people think that that's an artifact of investing. And I think it's incredible, right? It's the eighth wonder of the world. But I think it has deeper roots. I think you really think about physics at its most granular state. There's an essence of compound interest at the core of what everything has emerged from. And it's a fantastic thing as an investor that we get to play with this very powerful universal law. And but yeah, that's exactly right.
Sir John loved that subject of the laws of life and universal laws that kind of guide the universe in these mysterious ways. And in fact, he funded an essay contest around the U.S. and later around the world where young elementary school children would try to write about what the laws of life were to them. And, Sir John had very varied interest, and it just makes me think of him during this discussion. And one of the things, and this is very philosophical, but it also has a thread of compound interest in it, is he had this one quote, and he was deeply interested in philosophy and religion and spiritual matters. And he said, it's so off topic for an investor, but it's so true when you think about it. And it's fascinating. He says, the more love we give away, the more we have left. The laws of love differ from the laws of arithmetic. Love hoarded dwindles, but love given grows. And it's this concept of marrying something spiritual with something that's almost like inherent to compound interest, that something grows and expands over time. It's a fascinating subject. But I do think going back to like the left and right brain matter, which kind of got us off on this course, the really great investors all kind of tapped into something out of the right side of their brain. You just see so much creativity and, well, Sir John, innovating into international markets, or Warren Buffett with what he did with Berkshire Hathaway is just this ultimate flexing of creative thinking and analytical thinking. And you got Charlie Munger in the mix and they reinforce it. It's really cool stuff. So I guess, I guess my question is, as a professor, what do you do to cultivate that exploration of the right side of the brain among your students?
Thanks for reading that quote. And Scott, you have to send me that quote. That is beautiful. I think I think we incorrectly see the world very linearly, where 1 + 1 = 2. And when you see that the world is complex, it's not complicated, it's complex, where 1 + 1 equals much more. And that complex systems are sensitive to initial conditions and feedback loops. So I think what Sir John was talking about is this: when you move from scarcity, like where there's not enough, to abundance, there's a leaping emergent effect, just like in complex systems. And we're playing in the world of exceptional, right? Exceptional companies. I mentioned the Mendelssohns, where as an investor, you're like, oh, I didn't expect to get that. I didn't model for it. And I think that's what a good life is, right? Is you keep giving and you keep getting, you get more. So to nurture it, it's hard at Columbia, I'll tell you, because I think a lot of the students are very much in a hurry, that they've come, they're in New York City. There's a lot of competition for jobs. There's a competition for how much you'll make. And what I'm trying to teach them is how do you pause a little bit and do it the right way? So I think that's I think that's what Sir John was talking about there. So
yeah, I've heard you compare, and this is speaking of complex systems, I've heard you compare quantum mechanics to investing, which I thought was such a great way to describe it. The unknown. Can you describe that a little bit for the audience?
Oh, that's great. So I'm just finishing a piece called The Joys of Unknowing. So this concept of unknowing has been, something I've been thinking about now very deeply for a long time, but now it's on paper. So, the known world is, what we can point at, and kind of as we go into, I think, a spectrum of intelligence and truth and what's real, is you're going from the known to the unknown. And I think especially in investing, it's crossing these realms. And so, just the 4 tiers that I think about are, knowledge to wisdom, which is experience knowledge, to intelligence, which is making something complicated simple. It's allowing more information to flow through a system that could be personal, could be business, could be investing, to this last pillar, which is virtue, quality, excellence. And that's the full unknown. And that's where the magic really happens. So in quantum mechanics, when we try to go deep to figure out that thing, what we figure is the thing that we were thinking, there's no thing. It's this quality that exists at that unknowing. And so what I've arrived at in this what I'm calling the joys of unknowing is how do we live at the leading edge of the train? What Person called in his book Zen and the Outer Motorcycle Maintenance and Lila, it's like dynamic quality or arete or excellence lives on that dynamic edge, that leading edge. And that leading edge is an unknowing. It's an asymmetry that exists at the horizon edge. And and so, what I've seen in businesses and systems that truly create value in the world is they're right there. And you can't point to that one thing. It's emerging and manifesting ahead of them.
Yeah, I've written down something that you said, which is just that the uncertainty that physicists deal with is similar to the uncertainty investors face. And I love that. Scott's always saying that in our office. He's like, well, it's a good decision. It may not have a good outcome. You never know. You're always dealing with uncertainty in any decision. Yeah.
And just to be clear, because we don't invest with the idea that things could be uncertain. We want them to be asymmetric, and we like certain uncertainties. And so certain uncertainties are really interesting. The ones that particularly if you're in the right system. Now, Berkshire Hathaway, we'll use that as an example. how would they do in a really uncertain, volatile environment? Well, they're going to thrive. They're going to actually emerge better from that experience than the lion's share of all their companies because they're built for that. And so we love to invest behind companies that are anti-fragile, said that they built for the 100-year flood, that everyone else is built for, the 5-year flood table, not the 100-year flood table. And so that's really kind of these certain uncertainties that we try to set ourselves up for. And I think in life, that's when you're, I think we're seeing this with the banking crisis, right? Yeah, sure, we could have got a little bit more yield by lengthening our duration, but what happens if interest rates spiked up quickly? And so you see how fragile these systems were when that happened. So these certain uncertainties in quantum physics, as you said, are just wonderful little models to kind of see kind of a fractal that exists across many systems.
And I can't help but add that, as an investor, you start to crave certain uncertainties because that's where the mispricings occur.
That's exactly right.
March of 2020 or any other kind of catastrophic type event, that's where the best opportunities lie, which is interesting.
Yeah, since we're talking about quantum mechanics, like an electron, like you try to find the electron, you can't find it, right? It exists in a cloud. And so clouds are what we are looking for. So if you hear a dialogue internally with my team, it's where are the clouds today? And we know that within the cloud, there's likely something that is mispriced. So where are the clouds today? Well, it's probably commercial real estate because that's kind of scary. We're not sure what that's going to look like. There's a lot of moving parts. Banks are being put back buildings. And, we have this new paradigm of hybrid work. What's that look like? Well, certainly there's a cloud there. You could have looked back a year ago and looked at, maybe some of these social media platforms that had a lot of clouds around, different iOS changes and so forth. And, so we try to identify macro clouds and micro clouds where we think there's likely some uncertainty, there's likely some fear, there's some apathy maybe that could create the environment for mispricing. And so that's really one of the most important things. I call these the known unknowns. We know there's a cloud, but it's kind of unknown. And that's the part of the work that we do as analysts is let's create a probability tree to understand the known unknown. And if we can understand it, and we have a duration mismatch, meaning, hey, we're willing to kind of go through this period of uncomfort for a year. So then the other side of that will be rewarded. And that's generally been the case with, I think, a lot of things that have worked for us is just that willing to be a little uncomfortable in the uncertainty, knowing that there's a certainty on the other side. Or an inevitability is probably a better word.
A good value investor gets comfortable living in that space and learns to look forward to it. I mean, Uncle John didn't call it clouds, but moments of maximum pessimism, whether that would be in a security, an industry, or a particular geography, that's where he really looked for opportunities. What other things do you look for when you're investing in a business? If you could just walk us through your process of how you make these investment decisions.
Yeah. So 3 things that we're predominantly looking for in what we define as the exceptional company. Moat. Moat is most important, like competitive advantage. Why is it enduring through time? And we're really trying to understand why should the moat widen over a 5+ period, ideally 10+. So we have 8 layers of we're kind of drilling down there. And the second thing is secular tailwinds. So we tend to avoid most businesses that are facing secular headwinds. It's really hard for us to understand how quickly those may erode. I think nowadays versus 5 years ago, if there's a known secular tailwind, a headwind, it's probably going to be it's going to hit them even faster than what we've been able to model in the past. So secular tailwinds are really important. The third thing is a history of intelligent capital allocation. Ideally, we have great capital allocators that are just fantastically reinvesting our capital, buying back stock when they should. But that's been an important part, I think, of the ones that really have run the cash register over time. And then we look at those. That's called our Grove of Titans. Here's a list of, call it 120 to 150 companies globally that kind of meet a criteria of having those three attributes. And then what we do is we really build a 10-year free cash flow model to understand, what's the growth of free cash flow, price we're paying today, reasonable, terminal multiple based on that moat, where we think it'll be. And that's our IRR. So the internal conversation that we have is, here's our Grove of Titans, we call it. Here are the IRRs we think over a 10-year duration. The process is giving us ideas for things to do. Here's something at a 19% IRR today. Here we've identified the clouds that we think are giving us the opportunity. And let's focus on doing our work to say could those clouds disperse over short term, medium term, or uncertain, maybe too difficult to figure out. And what we're trying to do is buy 15% or better IRRs, continue to build that portfolio around that. We think if we do that, that'll generate really good long-term returns.
How do you think of capital allocation across geography? Like, how does that factor into your decision-making process?
Yeah, I'll just rattle through our 6 principles because they're really important. Research-focused, exceptional businesses, disciplined and patient around value, long-term orientation, concentrated. And then the last one, which you just spoke to, is to operate unconstrained. Mm-hmm. Unconstrained. And that means geography, industry, market cap. And so our Grove of Titans universe is very global. I want to learn more about even more non-US businesses in the future than we even know today. So that we know there's a lot out there that are hiding in plain sight that we haven't discovered. So let this be an echolocation call to some of your listeners that can mention a few to us. But we're always trying to add to our Grove and broaden our understanding. So I admire Sir John for how he thought about global investing and how important it was, because he would be in countries that no one was even thinking about. And all of a sudden they look back and like, oh yeah, that was obvious. And even Warren's done this. He's in Japan doing these, trading houses, and he's South Korea at, 6 times earnings. And, so our mandate and our core principle is to operate unconstrained geographically. And we've really attempted to do that.
Yeah, I think it's so smart. Uncle John used to always say, have the largest universe of stocks available for your selection. It's only common sense to do that.
Absolutely. I mean, we are, to live in the U.S. and we have an incredible pool of businesses here. And so we certainly have oriented, to those over time, but it's we're very open-minded to wherever the geography might be. Right.
They're more neglected companies outside of the U.S. It's also really easy to get information these days on companies. When Uncle John, it always amazes me that when he operated and he was investing internationally, that information was really hard to come by. So he really lived by what he called the doctrine of the extra ounce. It's the little bit of extra work you do over the guy next to you that's going to separate you from the crowd. And so the extra report, the extra time you took understanding the accounting principles in Japan in the 1960s, that was going to accrue to the benefit of your investors. And
go to the source. I mean, one of the things I think that you referenced is the willingness to get on an airplane and going out and touching the medium, right? Like, as investors, it's easier for us to sit here, read the annual report, and think we know everything there is about a business, but actually go out and meet with these businesses, understand them, meet their customers, and build a real tangible understanding of what this business is, what's the culture of it. And that helps us. One of the things that I've learned over, 2 decades doing this is you can't outsource judgment. Mm-hmm. And so to have judgment is to touch the source material. So we actually have an active process if we're coming up and getting something close to a finish line to be included in kind of our sub 10 portfolio, we don't want to be convincing another team member. We want them to have read the source material as we go along, so that we all have a working understanding of the key attributes of the business, and not just one person kind of carrying it and convincing others. So it's part of the way that we operate.
I completely agree with you. That's why we don't actually employ analysts at Templeton and Phillips, because we found that it really didn't save us any time, because we feel that our edge is on the behavioral side. And ultimately, when the rubber hits the road, we have to have conviction in the position. And the only way for us to have the conviction in the position is to have done the work ourselves. So it is. I was going to ask you, this is a little bit off topic, but since you're a professor at Columbia and you're dealing with students every day, I just had a little debate with a group of professional investors we were at the Berkshire Hathaway annual meeting at a barbecue. And the question was, would you advise a young person to go into the investing field today, or is it just too competitive? And my response was, I think Sir John would have definitely said, do not do it. Do not go into investing. It's too competitive. Find a different industry where there's less competition. And there was a little back and forth with this group of investors. And I'm curious, do you think that there are just too many students and managers studying investing, following Warren Buffett, going to the annual meeting, reading all the 10Ks and 10Qs? I mean, is there an edge there that's worth pursuing?
Absolutely, there is. This is what a beautiful art that we can enter into this business. So, our universe is public equities. We're trying to find a handful of businesses that we can really own for a long time and earn superior returns, alpha over benchmark. That's substantial. And I think there's a lot of really good students that can actually have the temperament to be really good at that. But I think if you're going to do it and you're going to be part of a large, institution and so forth, that path may not be for everyone. And, so I think it all depends on the student, but I meet students that are on fire about doing this, and I know it's going to be the perfect thing for them. But for others, they're not on fire about it, but they're doing it because they're just checking boxes. They're probably not going to be exceptional at it. So it all depends. One thing I would say to some students who is if they're thinking about a path of operating a business versus being an investor, go operate a business. Like, really understand how to run a business. Set up a lemonade stand. Like, what's this look like? What's like receivables, payables, like build your own financial statements. All this stuff is really going to make you a much better investor. So, that to me is something that I always would recommend, and then come back, and you're going to be much better for it.
Completely. I definitely agree with that. I actually started a company in, maybe 2015, because I needed to refresh myself. And it's an e-commerce business. It's still open, still managing it. But I just needed to get back to, I know I'm growing an investment business. And yes, I'm definitely running a business and have employees and understand that. But I needed something else. And it was really refreshing to conceptualize a business from, infancy stage. Like, here's the business plan, the business model, here's the logo, that was really reinvigorating for me to get back to just core business principles. And I think it only makes you a greater investor to understand business through the eyes of an operator.
Yeah, one of the things that, as a family, we've gotten into hospitality, over the last 10 years. And it was so eye-opening to me, because you go to a hotel, you kind of know what it feels like when you're in the presence of quality. But to try to operate a business at that leading edge of quality, and you've been at that, and it's such a fine line. it's all of the details. It's getting everything right, not just a handful of things right. Everything has to be right. So I think being in hospitality and thinking about quality investing the way we do is, there's so many parallels to that.
Yeah. Isn't it beautiful though, when you see even the smallest job perfectly executed and all the detail? I mean, it's such a beautiful quality to experience.
Yeah. And I think the Japanese aesthetic really got this right. Like if they were in a tea ceremony, if the tea ceremony wasn't just about drinking tea, it was, how do you prepare the tea? How do you, from the minute, how does it feel? What's it smell like? Like everything was important. So it was almost like a little fractal of how you should live your life. So yeah, I think that's one of my perennial speakers that in the class is Nick Sleep, and Nick's written some beautiful investor letters, but we often talk about quality, and we share a love for Persig's work, Zen and Lila, and I don't think anyone has talked about quality at the level that Persig has, because it's such an ineffable state, right? That we're talking to, but it's so special. And I think life is such where a lot of us that naturally congregate in these conversations, right, are just so moved by it.
Absolutely. The other thing that's you've kind of provoked me into thinking more about during this discussion was, operating a business and favoring quality and some of these kind of value systems, so to speak, speaks towards some intangibles as an investor that you might not pick up on if you're just studying through the classroom, which is the culture of a business. And then not only the culture of a business, but the alignment of principles as an investor with both your clients, your belief system, and the companies you invest in. And if you go to a place like the Berkshire Hathaway annual meeting or the Fairfax annual meeting or Markel or any of these other kind of congregations of value investors, you see this kind of eerie alignment of all these people. Like, you're having a great time, you're hitting it off with all of them. They're all wonderful and nice. And it's interesting when you see these kind of concentrations of that. And I think as an operator of a business, as an investor, you can toggle and maybe have the ability to see that in a potential investment. And if you don't see it, conversely, it could be a warning sign.
That's beautifully said, Scott. I was at the Berkshire annual meeting as well, and I just closed my eyes, and you're in the presence of these 40,000 people in the auditorium. And it's like, why are we all here? Is it really to hear from Warren Charlie? Sure. But it's that feeling that we're part of something bigger. And it's, I wrote a section of this year-end letter, and I called it pattern recognition. Silent the eyes, listen they see. It's an anagram, right? So if you actually play listen and silent, so when you silent the eyes, listen they see, it talks about hearing, listening, deep listening. And so one of the things we do with the businesses that we're investing in is we listen deeply to what management says, and do their actions meet their words? And that's subtle, right? You pick it up so subtly, but the more you listen, you can see the little oddities that, that doesn't make sense, that doesn't add up. You don't get that just by reading one annual report. It's a accumulation of that, and that speaks to the culture, right? Like I mentioned, the Mendelssohns, and everything that they say is demonstrated in their culture. It's in every interaction that you have with them in the business. So it's that consistency and the constancy that builds trust, right? And the reputation that is deserved.
Yeah. I often comment on that, and I'm sure my listeners have heard this many times before, but I did not place I placed value on culture before going on to the Fairfax board, but I just didn't understand how powerful it was. And after being on the Fairfax board and seeing the culture expressed in every detail of the business, I mean, it's in every little detail. how really powerful that is, how it does create a culture of trust. And I mean, Fairfax is, fair and friendly acquisitions. So I've heard you talk a lot about when you're doing business, it has to be a win-win for everybody, for the business to be sustainable over the long term. And that's the way I think about Fairfax. It's really changed my perception on business since joining that board and seeing the power of culture when it's done right.
When it's done right. And I mentioned the 8 layers of competitive advantage. The 7 are those that we can actually point to. The 8th is culture. Mm-hmm. And it's a culture of quality, right? It's that arete, the virtue and excellence at the leading edge. And it's, I never start with there. It's never like, oh, that has a good culture. It's like, no. You have to have the other things to then build the culture. And the culture is because you have the other layers of competitive advantage that allow you to be win-win, allow you to operate over a long duration, to protect your employees, to protect your ecosystem. So culture for me is always that last piece that manifests later in the understanding about the system, about the business. Because like with Fairfax, it's like they had to do a lot of other things right so they could build that culture of excellence, which then became even stronger.
But Chris, how do you teach your students to measure that?
It's hard. And that's why, Peter Kaufman is one of my annual speakers. He's like the culture guru. Like I bring him in. Sometimes we'll go and actually visit. And I've taken the class out to California for, I think, 5 years pre-COVID. And we'll spend the whole day with Peter. And, I think you leave that experience being around a great culture to be able to understand a culture. So I think it's that part of it. It's like once you have worked with Fairfax for long enough, you're like, okay, now the bar is here on what I think culture is. And so I think just being around good cultures and understanding the contrast is probably how I would teach it to others, because it's how I've learned it.
Mm-hmm. I think being around it, you also learn you just see it in other businesses. You can spot it easier. And it's really the consistency and the messaging and the people that you meet that are in the network of that business. It's all so important.
And being kind, right? Like I have this expression I always say, like to myself, or at least be constant, be kind. Like there's a kindness, I think among great cultures on how they treat each other and how they treat every counterpart that they have.
Mm-hmm. I think of it more of a gentleness,
Gentleness. I love that word.
Yeah.
A grace.
Yeah. A grace. So you can make hard decisions. You can do hard things, but do it with a gentle hand is the way I think of it. Almost like parenting, although I'm not always gentle. My kids sometimes frustrate me. Well, tell me, how are you seeing the world right now? Where are the investment opportunities? Are you excited? Or are you making a lot of changes to your portfolio? Or are you not? Where do you think, what is keeping you up at night?
Thank you, Lauren. Yeah. So I always go back to the clouds. If you were to task me with where I thought valuations were across the universe, 1 to 10, I think we're somewhere kind of 10 being kind of most attractive. We're probably like a 6 across the board. Like, I'm seeing a lot of 12% IRRs in the universe, maybe even 10s and 11s. We have a handful of things I think have clouds that we think will disperse over, I think, a time horizon that is acceptable to us, that are kind of in the upper teens. So that gets us excited. Like I said, we own, currently 8 companies. And, of the 8 businesses, we feel pretty strongly about the return profile of those over a 10-year kind of underwriting period, kind of in that high kind of teens. And, but I think the overall market is not to be excited about. That's how I'm seeing it. We saw kind of a nice recovery this year. I think if we have persistent high inflation, kind of upper fours, that's hard to get rid of, that on a compounding basis can be really a challenge. It's a challenge to run businesses in that environment. We're not used to doing that. So I think that's probably not in consensus thinking. So we're kind of eyes wide open to the fact that, there's a fair amount of quietude right now, the silence that gets me like, okay, there could be some volatility ahead, which we get excited about. It's in those periods of greatest volatility that we think we could add the most value with a kind of prepared mind. So, we're looking for micro clouds, things that we think are creating uncertainty. So a few of the businesses we're working on today, one just kind of made it through the portfolio, like really identifiable micro clouds associated on the individual business side. Certainly any micro volatility will help us. I'm thinking a lot about AI. AI has been certainly very topical this year. The LLM inflection that's happened over the last 6 months is very monumental, and I think we're in a period of unknown there that we need to have the right conversation around, the right thinking. We've been active in those conversations, I think, for the last decade with I think some of the leaders in this field, and we're trying to, I think when you look at AI and these LLMs, they mirror humanity. They mirror what it is, all of humanity. So you could say, it's the whole bell-shaped curve. And I think there's a way to refract the best parts of humanity as we continue to build out AI, where it's more heart-centered. It's more, it can be tweaked for win-win critical thinking, where second and third order effects are not negative but positive. And so social media, the issue we had, I think, and continue to do with social media is it amplifies those tails, right? It's the whole mirror, and then you're amplifying the tails. I think as we build AI, we could build it in a way that it doesn't amplify the tails, but it minimizes the negative tails and enhances the positive tails. And so that's something that's hopeful thinking. The conversations that I'm interested in having with the leaders in this field is just, how do we do it? How do we architect safety measures that are going to be really important at this stage?
Yeah, the AI cloud. I'm so glad you brought this up, Chris, because it's such I think it is transformational. Obviously, I think the people that are saying that this is going to change everything are spot on. The questions are how and where and when. But one of the things that comes up as a value investor, let's say, we all know kind of the linear companies that have already participated in this fervor, the NVIDIAs and some of the more heavily involved but more derivative plays like the Alphabets and the Amazons. But the question really, as a value investor who may look at an NVIDIA and say, well, that's great, but we can't invest there because it's already taken off or whatnot. There seems to be a discussion that is yet to kind of coalesce or materialize between, and I'm drawing on an interview that you gave to Graham and Doddsville, I think, where you talk about the three types of value plays. There's the compounders, the transformations, and the workouts. And those transformations are very interesting from a value investing standpoint, because you really do look at across this kind of spectrum of businesses are still figuring out the cloud, the technology of the cloud, then AI on top of that, and how that's going to unlock value, kind of pierce that entropy you talk about and unleash value to their customers. And then you've got these companies that are low multiples and may expand their margins pretty dramatically in some cases if they can figure this out. And that to me is kind of this lurking value play that no one's really talking about. And it would have obviously important ramifications for investors in the stock market too over time. So I'm wondering if you have any thoughts on that or poked around at that at all.
And Yes, Scott, the transformation category, when I think about that, I think of these companies that have kind of even been kind of known as being maybe average performers. When I think of the railroads that may be, return on invested capital of like 10%, 12%, and then all of a sudden they go through this inflection where they're actually high return on invested capital business on a go-forward basis. And so to see around those corners, I think has been a valuable tool. So how some businesses may employ AI and have an inflection in their own profitability and economics is certainly an area of focus. And, I would, what we would say with AI is that there's a lot of things that are flashy now. I think the NVIDIA report, everyone's like, whoa, raise guidance 50%. And, that's in the multiples and so forth. So but there are areas that are likely that in this disturbance that are probably people aren't focusing on it, but you might have some asymmetries, free call options on AI can be employed to enhance their, which would be most important to us, their sustainable competitive advantages. And so when we saw, Alphabet and, there were a lot of asymmetries in AI that weren't being discussed a year ago, 2 years ago, 3 years ago. I was lucky enough to meet Demis Hassabis early on and through a mutual friend, and, to be part of just to see what he was doing firsthand, and to see the success that he had with, AlphaGo and now AlphaFold with protein folding. It's so moving to me. And so I am witnessing the benefits to humanity of AI tools, not just what is getting a lot of the headlines is, oh, this is awful for humanity. I think there's a way that it could be very, very hopeful and very, very positive. And that's, we tend not to think in binary terms, but try to see the whole picture and understand that this is a natural evolution of technology and human intellect.
Yeah, well, Chris, we actually have a few questions from my audience members. So let me try to read them. I don't have my glasses here. What is your view on investing? Oh, Scott's going to share his glasses. This is the benefit of working with your spouse.
Oh, you guys are closer than I expected.
Yeah, we can share things. Majid Ahmed has asked, what is your view on investing in alternative investments like private equity, private credit, or venture capital?
Our kind of sweet spot right now and has been for the last 20 years is long only public equity. And so that's the area of our focus. And in our fund, we have some capabilities to do privates, but we haven't, exercised those. And so I would, like you said, operate unconstrained, but right now that's not something we're doing directly. We have looked at businesses that operate in that realm in say a holding company form. And so, say a company like Brookfield, I think Brookfield right now with Bruce Flatt running that business, I got to know Bruce over the years. He's been a speaker in the class. Are there some clouds around commercial real estate now? And who's set up to perhaps be very opportunistic in an environment that there's a lot of uncertainty. So Brookfield has a lot of pillars. They have their real estate business, they have their infrastructure business, they have renewables business, they have a private equity business, they have Oaktree and distressed credit. So they have a lot of levers to pull that speaks to the question in these areas when they should be pulled. That's most important. Is if you have a hammer and your hammer is distressed credit and that's all you have, like sometimes it's not the right hammer. You want to have a lot of tools. And I like Brookfield from that standpoint in the sense that they're very they have a lot of skin in the game and they can orient around what is reasonably priced at the time. So I would kind of think about that would be one way that we would be involved in seeing something that we think is attractive, that also kind of fits all of our three pillars.
Yeah, that makes sense to me. The next question is going to be from Mark Zashin. And it goes on to the conversation you and Scott were having about AI. But how do you view NVIDIA and AI, and how is it different from the .com craze?
Yeah,
is this a bubble?
So the bubbles are always perfect in hindsight, aren't they? It's like, oh, of course, it was the NVIDIA earnings note. That was the thing. But, I think when we're in the midst of what's happening now, what I'll say is NVIDIA is the picks and shovels in the gold rush. Like, there is a massive investment being made. If you just look at the CapEx of Meta over the last 2 years, we literally are looking at these numbers and just scratching our head like, what are they spending this money on? There was so much capital expenditures. And what they were doing is they were buying chips, right? They were building in-house their own capabilities to harness AI. They weren't building it on a public cloud. They weren't utilizing Amazon servers. They were building it internally. So we saw a major investment in those picks and shovels in this gold rush, which is AI. Everyone's having the capability to have LLMs internally, or they're harnessing it through the 3 public cloud providers. So my answer to that is I'm not sure if this is a bubble. I think it has the setup to produce some bubble situations. What's always important to us is leaning on free cash flow. We can actually understand this is the free cash flow generation, the unit economics of the business, and this is what we think it's going to look like over the next 5 to 10 years. And then what do we have to pay for that free cash flow stream? If we can't answer that definitively, and we have a lot of like uncertainty in that, we just avoid it. It's just, and that's how we've decided is you can't understand at that level everything. And that's what a lot of people got in trouble when interest rates were 0. And I think there was such a distortion field, right? Oh, this company will be free cash flow positive 5 years from now, 10 years from now. And so we saw this with so many businesses that were and now they're down 80%, between 60 and 90% on a lot of these companies that were darlings of that period. But the free cash flow generation just wasn't apparent. And it's like, if you can't be free cash flow positive now, when are you going to be?
That's a good point. Well, this has been so enjoyable. I have one more question from the same audience member. He's very excited that you're coming on as a guest. But he says, do you have a threshold for returns on invested capital? And what happens when one of your holdings goes below the returns on invested capital threshold? Do trillion-dollar tech stocks prove to you that they have a long-standing moat?
Ooh, there's a lot in that question.
Yeah.
So ROIC, or return on invested capital, again, operate unconstrained. I would say more often than not, I don't trust stated ROIC numbers. Just we'd really want to scrub the numbers and understanding what's the unit economics and what is our true return on invested capital of the business. What do we think the business earns? So we don't try to paint by numbers. We just really understand, start peel back the layers and say, what does this business do? What do they sell? What are their margins? How much investment's needed in the business? And what do we think that free cash flow generation is going to be? How much maintenance CapEx are we going to need to run the business? So those are things that we're just getting our hands dirty on. We're not trying to do it on a screen, like ROIC above 20%. It could identify some ideas that might be attractive businesses, and so, there could be something that screens at 10% ROIC. That's really a 20. Like, when you really scrub the numbers, it's like, no, this is a 20. Those GAAP earnings are not right. So oftentimes that's happened a lot is we find things that are actually way more attractive than they might screen. But generally, I'd love to buy things 20% better ROIC. And that ROIC over time is going to equate to maybe some of their, compounded returns, right? The second part of the question spoke to trillion-dollar market caps. A trillion-dollar market cap could be the cheapest business in the world. Not sure. It depends. It all depends. I think Google could, 3 months ago may have been the most attractive business in the world at the asymmetry of those returns. So we're not scared off by market cap. We just bought one of our new businesses is $4 billion market cap. We own things at $1 billion market cap. So market cap is not a function of value. It's the free cash flow generation on what we have to pay for the enterprise is most important.
Great. Well, I have two fun questions for you. Firstly, and I'll have to describe it because a lot of people listen to the podcast, just audio version, but you're sitting in your home office and there are two stacks of books behind you. And I guess this is a piece of artwork, or these books that you've actually read, and what's stabilizing them? They're like 10 feet tall a piece. You clearly don't have a dog.
I do have an English cream golden retriever.
Oh, we do too. We have an English cream.
Oh, what's his name?
His name is Cash. He came with the name. Our other dog is a boy named Sue. So it's a Johnny Cash kind of theme going on. What is yours?
Max, after James Clerk Maxwell, the father of electromagnetism.
Oh, well, yours much smarter.
But these bookcases I love them because they're actually all individual. So it's not stacking. It's not going to fall down, but they are oriented this way. But they're called sapient bookcases. They're vertical for your listening audience. And I am in my home office, and I live about a mile from the office, but I thought it'd be fun to do this here, in a quiet place with no interruptions. And you mentioned artwork. One of the things I've been getting into this spring, and I've never done this before because I told myself I wasn't an artist, is I've taken up painting with my little boy who's 4, and we created a little art studio here on the property, and we just been painting. We started with watercolors, and I've graduated to oil painting, which is very messy, but I'm having so much fun, and I've kind of leaned into this this concept of unobstructed self-expression. Not being the artist that orients to who you are. And this is investing or anything. But when I realized that, okay, I don't have to be this perfectly illustrative painter where it's going to look like the reality, but I've kind of been leaning into expressionism or leaning into like what this landscape feels like to me. And I've had so much fun with it. So, and my little boy, River will just be, I'll look over at his, we set up our little easels next to each other. I'll look over at his. He's kind of like doing what I'm doing. And so it's just taught him a little bit about, hey, we're all artists. There shouldn't be this feeling that we have to, that this is an expression. So I found it to be a really fun hobby that it's turned into. It's just like if I have 15 or 20 minutes, I'll just kind of, throw up a little something on the easel and play. So
that's a lot of fun. I've done that a little bit in the past. I have not done that in a few years, but when the girls were smaller. And I actually threw out a canvas one time, and the Public Works Department and Lookout Mountain now has that piece of artwork in there. Like, he was like, I found it in your garbage. I think it looks great. I'm like, well, I mean, to each his own. I don't know. I was like, oh gosh, I don't know if I want all my artwork out there like that. My next question for you is in regards to your surfing and water sports. Can you tell me what has attracted you to this hobby?
Yeah. So, it's one of my passions. Originally it started with, growing up on Cape Cod, being around water all the time and just loving to play on the water, and if it was behind the boat or if we were skimboarding. And, I'd say over the last 15 or 20 years, it's oriented more towards surfing. We have surfing here in the Northeast. My family spends a few months down in Central America where we are more accessible to surfing while our working days. We have mornings and evenings. Where in
Central America?
So we're in Costa Rica.
Okay. I've never been, but I've always wanted to go.
It's become a lovely part of our adventure and journey. And the locals are just, become so many of our best friends. So, so surfing is such a lifelong, something you can do forever. It's active. The community that you're able to be a part of, it's very simple. You have a board, pair of board shorts, walking out. Here in the Northeast, we wear, thick wetsuits, but it's okay. I've taken up foil surfing over the last 6 or 7 years, and that's been a passion that is kind of, I always try to say, how do I make myself a little bit more uncomfortable and orient on something that might be a little bit more challenging. So, but it's something I'm loving. Actually, been doing less surfing over the last month and a half, and more mountain biking here in New England, and on trail and hiking and stuff like that.
Yeah, that's so fun. I love outdoor activities. And Scott and our office is also about a mile from our house. So I don't think that is, I think that's very similar with investors, that really thoughtful investors find a way to organize their life that is convenient. And like, we live in a place where we can easily, the outdoors is easily accessible. I mean, I walk across the street and I'm on a trail that takes me along the side of Lookout Mountain. And I think it's so important to the way you build your investment business, the way you think, the way you organize your day. So,
yeah, I think when you look at Warren in Omaha, Nebraska, living in his first home, and Charlie in Santa Barbara in LA, you picture how they're reading, and how that sets up. It's part of their competitive advantage, and geography was a big part of how we oriented where we put East Coast, and how it sets up for just deep thinking, taking a lot of meetings, not being distracted, and that's been really important to us. I've been to your neck of the woods. You had mentioned before we started recording, being on the Chattanooga River, and such a beautiful place where you both live. So
yeah, it is really beautiful. We enjoy working and living here, and we also really appreciate the time you've spent with us today. This has been a fascinating conversation. I'm glad that my audience is getting the opportunity to learn from you and to meet you, for those that have not met you. And I wish you all the best. And I know we'll stay in touch. And the next time you're in Chattanooga, you'll have to come on over and visit our office.
Absolutely. Thank you, Lauren. Thank you, Scott. Really, really enjoyed this.
Thank you, Chris.
Thank you, Chris.